Congratulations. Now let's get smart. Coming into a lump sum of money is exciting. Maybe it's an inheritance, a work bonus, or even lottery winnings. Whatever the source, you've got a fantastic opportunity to build a secure financial future. But before you start dreaming of lavish vacations or a new car, let's talk strategy. Take a deep breath and remember, smart investing is about making your money work for you over the long haul. The first step is to assess your current financial situation. How much debt do you have? Do you have an emergency fund? These are crucial questions to answer before making any investment decisions. Remember, a solid financial foundation is key to building lasting wealth. Think of your finances like building a house. You wouldn't start with the roof, would you? You need a strong foundation first. That's what we're going to focus on, creating a secure base for your financial future. This way you can watch your money grow with confidence and peace of mind. Remember, this is your money, your future. Let's make smart choices together. First things first, clear the decks. Before you even think about investing, let's talk about debt. High-interest debt, like credit cards, is a financial drain. It's like trying to run a marathon with a backpack full of rocks. You need to lighten your load, pay down those high-interest debts as quickly as possible. This will free up more of your money each month, allowing you to invest more and build wealth faster. Think of it as giving yourself a raise. Next, build your emergency fund. This is your safety net money set aside for unexpected expenses like car repairs or medical bills. Aim for at least 3 to 6 months' worth of living expenses in a readily accessible account. Having this fund will give you peace of mind and prevent you from going into debt when unexpected costs arise. It's like having insurance for your financial well-being. Once you've tackled high-interest debt and built your emergency fund, you can start thinking seriously about investing. Remember, these are the crucial first steps to securing your financial future. Now, let's talk about diversification, a fundamental principle in the world of investing. This is a fancy word for not putting all your eggs in one basket, a simple yet powerful concept. It's about spreading your money across different asset classes to reduce risk and increase potential returns. Think of it like this. If you plant all your seeds in one small garden and a storm hits, you risk losing everything. This is similar to investing all your money in a single asset. But if you plant seeds in several gardens across town, you're more likely to have a successful harvest, even if one garden suffers. Diversifying your investments works the same way. Diversification is key to protecting your investments from market fluctuations and unexpected downturns. When one asset class is down, another may be up, helping to cushion your portfolio from significant losses and providing a smoother investment journey. There are many different asset classes, each with its own risk and reward profile. Some common asset classes include stocks represent ownership in publicly traded companies, offering potential for high returns but also higher risk. Bonds are loans that you make to governments or corporations, generally providing more stable returns with lower risk compared to stocks. Real estate includes residential, commercial, and industrial properties, offering tangible assets and potential for rental income and appreciation. Commodities are raw materials like oil, gold, and agricultural products, which can provide a hedge against inflation and diversify your portfolio. Cryptocurrency is a digital currency that uses cryptography for security, offering high potential returns but also high volatility. Cash includes checking accounts, savings accounts, and money market funds, providing liquidity and safety, but typically lower returns. Understanding the different asset classes and their characteristics is essential for building a diversified portfolio that aligns with your financial goals and risk tolerance. We'll delve into each asset class in more detail in the following sections, helping you make informed decisions. Remember, diversification is your friend and a crucial strategy for long-term financial success. Don't put all your eggs in one basket. Spread them out to protect and grow your wealth. Section 4. Stocks. Riding the market roller coaster. Stocks are like the exciting roller coaster of the investment world. They offer the potential for high returns, but they also come with higher risk. When you buy a stock, you're buying a small piece of ownership in a company. If the company does well, its stock price typically goes up and your investment grows. However, if the company struggles, its stock price may fall and you could lose money. Investing in individual stocks can be risky, especially for beginners. It requires careful research, analysis, and a good understanding of the stock market. Before investing in individual stocks, it's crucial to do your homework. Research the company, its financials, its competitors, and its industry. Consider factors like the company's management team, its competitive advantage, and its growth potential. If you're not comfortable picking individual stocks, don't worry. There are other ways to invest in the stock market, such as through mutual funds or exchange-traded funds, often referred to as ETFs. Remember, investing in stocks is a marathon, not a sprint. It's about long-term growth, not short-term gains. Section 5. Bonds and real estate, steady streams of income. In this section, we will explore how these investment options can provide a reliable source of income and stability to your financial portfolio. While stocks are known for their growth potential, bonds and real estate are often favored for their stability and income generation. These investments can offer a steady stream of returns, which can be particularly appealing during times of market volatility. Bonds are like loans you make to governments or corporations. When you purchase a bond, you're essentially acting as a lender, providing funds to the issuer in exchange for interest payments. When you buy a bond, you're essentially lending money to the issuer in exchange for regular interest payments and the return of your principal at maturity. This predictable income stream can be a cornerstone of a conservative investment strategy. Bonds are generally considered less risky than stocks, making them a popular choice for conservative investors or those nearing retirement. They offer a way to preserve capital while still earning a return. Real estate, on the other hand, involves investing in physical properties such as residential homes, commercial buildings, or land. This tangible asset can provide both income and potential for appreciation over time. Real estate investments can provide both income and appreciation. By renting out your property, you can generate a steady stream of rental income, which can be particularly beneficial for long-term financial planning. You can generate income by renting out your property, and the value of your property may increase over time. This dual benefit makes real estate a compelling option for many investors. However, real estate also has its downsides. Managing properties can be time-consuming and stressful, especially if you encounter problematic tenants or unexpected repairs. It can be illiquid, meaning it can be difficult to sell quickly if you need cash. This lack of liquidity can be a significant drawback if you require immediate access to your funds. It also requires maintenance, and property values can fluctuate depending on market conditions. These factors can impact the overall return on your investment. Both bonds and real estate can play important roles in a diversified portfolio, providing stability and income to balance the growth potential of stocks. Diversification helps mitigate risk and can lead to more consistent returns over time. The key is to determine the right allocation for your individual financial goals and risk tolerance. Consulting with a financial advisor can help you create a balanced portfolio that aligns with your long-term objectives and provides peace of mind. Section 6. The alternatives, commodities, cryptocurrency, and cash. In this section, we will explore these alternative asset classes, understanding their unique characteristics and how they can fit into a diversified investment portfolio. Beyond the traditional investments like stocks, bonds, and real estate, there are alternative asset classes to consider. Each of these alternatives comes with its own set of risks and rewards, offering different opportunities for investors. Commodities are raw materials such as oil, gold, and agricultural products. These tangible assets have been traded for centuries and continue to play a crucial role in the global economy. Investing in commodities can serve as a hedge against inflation. This is because their prices tend to rise when the cost of goods and services increases, providing a buffer against the eroding value of money. However, it's important to note that commodity prices can be highly volatile. They're influenced by a variety of factors, including weather patterns, geopolitical events, and the dynamics of supply and demand. Cryptocurrency, a form of digital currency that uses cryptography for security, has gained significant popularity in recent years. This new asset class has revolutionized the way we think about money and transactions. Cryptocurrencies like Bitcoin and Ethereum operate on decentralized networks, which means they are independent of central banks or governments. This decentralization is one of their most appealing features. While cryptocurrencies offer the potential for high returns, they are also highly volatile and speculative. Their prices can fluctuate dramatically, and the future regulatory landscape remains uncertain, adding another layer of risk. Finally, there's cash, which includes checking accounts, savings accounts, and money market funds. Cash is often considered the safest investment because it is highly liquid and stable. However, while cash may seem like the safest investment, it's important to remember that inflation erodes its purchasing power over time. This means that the value of your money decreases as the cost of goods and services rises. Holding too much cash can hinder your long-term returns. It's essential to balance liquidity needs with the potential for growth in other asset classes. When considering alternative investments, it's crucial to do your research, understand the risks involved, and consider whether these investments align with your overall investment strategy and risk tolerance. Consulting with a financial advisor can provide valuable insights. Remember, diversification is key to managing risk. However, it's essential to diversify wisely, ensuring that your portfolio is balanced and aligned with your financial goals and risk tolerance. Thanks you for watching.